Hey, Brad here again, and I want to cover something here just briefly today that I've heard from a number of people before, and I've actually read it. Dave Ramsey, okay? Everybody, Dave Ramsey, popular media figure on the radio all the time, talking about personal finance. A lot of the advice he gives is pretty good stuff. Most of it's common sense. I disagree with a number of things that he says. And keep in mind, he's got to do a couple things. He's got to take a strong stance. And he may be kind of animated about some of those stances in order to helps get viewers. Plus, he can't be wishy-washy. He can't say, "Oh, in this situation this works, and that situation that works." So, it's just a couple thoughts here. But one huge thing I disagree with that he says, and I don't know if he still says it or not, but I remember reading something about it here a few years back, where he would talk about your investments. See my crazy eyes here? This is my attempted artwork. I've got the crazy eyes because he says you should count on a 12% return from your investments and then take an 8% distribution. And to that, I say crazy eyes, 100%. Do not, and I repeat, do not go into retirement counting on a 12% return on your investments and taking 8% income. That sounds great. I mean, if you make 12% every year, then yes, you can take out 8%, your money keeps growing. However, that's not realistic. That has never been realistic, okay? Unless you can somehow predict the future and figure out what the best investment is to be in every year, okay? Here's why it's not. For one, I don't even think, you can't even look at an index over the past 50 years that has a 12% average return. Okay, they're just not that high. They're typically around 10%. Looking at stock indexes. There have been a lot of studies, okay, on retirement withdrawal rates, sustainable withdrawal rates, how much you can withdraw in retirement. There's always debate about it in the financial community, and I enjoy it. I enjoy getting into that stuff. I enjoy looking at details, seeing what's worked in the past, what hasn't. And again, we know nothing about the future and what's going to happen in the future. But what we're doing in these studies is we're just looking at the past, looking at guidelines, coming up with guidelines based on what's happened historically. And most people will tell you 4% is a sustainable withdrawal rate. And what that means is you start with 4%, whatever your balance is, say it's $1 million, you start with $40,000, and then if inflation goes up, you increase it with inflation. And actually some studies are different. Some you start with 40 and you increase it every year by 3%. Others, will have an inflation rule to where if there is inflation, yes, you increase your distribution. If there's not, you don't increase. So that's the most common one, is 4%. Then there's others that will do pretty in-depth studies that it depends on how you're invested. Okay, so how many different asset types you're invested in versus just say U.S. domestic stocks and bonds. Okay, it may add international, may add emerging markets, may add real estate. So numbers tend to get better as you add more diversification. But I've seen withdrawal studies that will go anywhere from 4 to 6%. Okay, so how much of a distribution you should take, that's something for you to figure out, something for you to discuss with your advisor and to figure out. The time horizon. Time horizon is a factor as well. The longer the time horizon, obviously, the lower the sustainable withdrawal rate. Okay, so if you're a law enforcement officer retiring at the age of 50, you're probably going to be looking on the low end. 4%, maybe if you can, go even a little bit lower, okay? There's people now talking about how, in today's environment with interest rates low, which are climbing right now, saying stocks are overvalued, so in the future we shouldn't expect to make as much, so maybe you should take 3%. I don't know, okay? That's something for you to figure out. Everybody is going to be a little different, but I do know one thing. This, counting on 12%, this, taking 8% withdrawal from your investments in retirement is crazy. Don't do it.